Yeah, if you look at the normalization of the yield curve, if the funds rate is going to say 3 to 3.25, normally the 2-year note will trade about 40 basis points above that. That puts it at around 360. And if the yield curve were to continue to normalize, and that is what I believe and a lot of others believe on Wall Street, then the 10-year note should trade about 100 basis points above the 2-year note, and that would put it at around 460, or call it 4.5 to 5%. Now, that assumes that the Fed cuts all the way to 3. If they wind up having to come up short of that, say stopping at 3.5, you adjust all those numbers up. Or if the economy turns severely south, then you could maybe start looking at the funds rate going into 2 or maybe approaching 1. But then the play there would be credit spreads are very tight and the stock market's at all-time high. They wouldn't survive that kind of a slowdown in the economy. So right now, it really looks like if the yield curve is normalizing and if the Fed is only going to cut, say, 150 to 200 basis points, then yes, 10-year note should start heading higher. And I think it's more like 4.5 to 5%.
You know, Jim, maybe this doesn't need to be said because it's so obvious, but in cycles past, right, anytime the curve either inverts or disinverts, in other words, starts steepening, which is what's starting to happen now, and is likely to ramp if you're right, and the 10 goes up to 5, it's accompanied by increased volatility. A, is that what you're starting to see already? And B, what do you do with it?
Yes, you should see increased volatility because historically when the yield curve uninverts, and historically we usually mean the 10-year 3-month bill yield curve, which is still at around minus 80 basis points, so it's got a ways to go to uninvert. That is typically associated with a recession or a lot of economic volatility, which shows up with financial volatility. You probably heard a lot of people say when the yield curve inverts, that's a recession signal. Actually, I think it's more when the yield curve uninverts. Historically, though, yield curve inversions only lasted about 40 days. And so you could pick the inversion date or the uninversion date, you get the same answer. This time, the yield curve has been inverted for 2 years. And so that's why the uninversion date needs to be delineated from the inversion date. So when it uninverts, it usually means that there's a lot of economic volatility, there's a lot of worry about a recession, and you see that in the financial markets. And again, that's the 10-year 3-month bill. That's still got a ways to go before it uninverts.